Hello, everyone. My name is Lucas Caceres. I'm a certified financial planner that works virtually with his clients out of Fort Collins, Colorado. And today I'm going to share with you my 2018 market forecast, and I titled it The Return of Volatility. So I'll dive in a little bit deeper as to why I gave it that name. But I will also turn off my video so that you can focus on the presentation itself. First up, just going to have to show you the disclosures that are required by compliance. Give you a couple seconds to read through all of that, and I imagine you guys are quicker readers than I am, so I will click off that now. I want to first start out by offering up a quote. So, facts are stubborn, but statistics are more pliable. That was originally said by Mark Twain, and the reason for that is I think it's with Facebook and Instagram and all the different social networks, it's really easy to be persuaded by information that is there invisible, or maybe it's even statistics itself that are being reported through social networks that make you think a certain way or feel a certain way. And I just want to remind you that it's okay to think for yourself. You don't have to necessarily always jump on something just because that's the most recent take on thinking about those types of things. And I just, again, think it's very important for individuals to be able to think for themselves. Even with my own clients, I make sure that what we're doing is always for the benefit of them and their plan. And regardless of what I say, it may be the best recommendation in the world, but I don't want them just to go with it if they don't feel comfortable or they don't fully understand those types of things. So again, I just think it's important to have a general knowledge and ask questions and make sure that you're making decisions based off of your reasoning rather than somebody else's reasoning or their statistics. Today, I'm going to discuss not just 2018 and that forecast, but what occurred in 2017, what's occurred to this date currently, which is towards the tail end of February in 2018, and talk about 2018 and beyond and what could impact the markets moving forward. 2017 was another smashing success by any stretch of the imagination. So you kind of see a couple of the common markets that people follow, may even include a majority of these in their investment holdings. And you can see the S&P 500, just to kind of quickly summarize what each of these means to you possibly, is the S&P 500 is going to be a lot of US-based companies, typically the larger US companies that you think about. And you can see that that performed 21.8%. So that's a huge return. Definitely something to be excited about if you were owning any of the companies that would fall into that. There wasn't too many places you could invest in and not make money last year unless you just really were undiversified and had really bad luck. But let's see how that stacks up towards some of the other investments that you may be owning. The foreign developed markets, that's going to be other nations that are like the United States, where there's definitely considered developed. They're not third world countries. There's infrastructure, lots of things in place. And you can see that those actually even outperformed us at 25%. So another decent return for those types of markets as well. And even higher than those two previous listings is the emerging markets. So those are countries that are kind of up and coming, maybe trying to get infrastructure in place or just had infrastructure in place within the recent years. And so those are considered still emerging markets with a lot of potential to grow. But again, they also have a lot of potential for volatility and risk because there's a lot of things that could possibly disrupt their growth. You could see that anyone that invested in those types of markets would have done even better than someone that just invested solely in the United States or the S&P 500. And down below, you'll start to look at some other alternatives to just owning equities in the markets, and that would be bond holdings, and that's one listed as specific to the U.S. bonds, U.S. REITs, and REIT stands for Real Estate Investment Trust. So if you think about that, think about commercial buildings, things of that nature is typically what would be included in those REITs. And then gold. So those are all going to be different alternatives that in most cases operate a little bit differently than the general equity markets, whether it be foreign or US based. And so one of the things that I just want to leave you with, and any of my clients would already know, is I'm very much a fan of having a balanced portfolio. So just because you have a balanced portfolio doesn't mean that you're very aggressive or very conservative. You can actually ratchet it up or down to be on either end of that spectrum and still be diversified and balanced. So diversified and balanced are always going to be my recommendations when I'm working with my clients. So then it's just a matter of aligning what their risk tolerance is and their goals to make sure that they understand how their particular assets are going to operate moving forward. So why did not only the US but other economies do so well? A lot of the facts are just because of the underlying statistics, the underlying companies and growth in the economies themselves have constantly been improving over the last few years. And 2017 was even more so. So there's been steady improvement in the economies in 2016, 2015, 2014. And there was a lot of statistics that showed that. But now things have gotten to the point where it looks like economies are going to be stable without as much government intervention, which has been the case in previous years where there's just been a lot of strong support from government policies. Low unemployment is a result of strong economies. And again, you kind of see the government policies that I kind of listed, the anticipated tax cuts. Those tax cuts, although they were anticipated early in 2017, finally did occur at the end of 2017. And most of them went into effect 2018. And you can see a few of my videos that I posted. I tried to stick to the ones that I thought were most relevant to my clients. So brief few minute videos on my YouTube channel that you may be able to find, and also on my Facebook page. But just generally summing that up, there's going to be impacts across all spectrums. So whether you're a consumer, individuals, married, filing jointly, or business owners, tax cuts across the board basically. Some more than others, and specifically businesses are going to have major tax cuts when it comes to some of the money that they're going to save on taxes. And so you've already started to hear it in the news a little bit, what some companies are planning to do with those tax cuts. There's also been a lot of support from government policies that have basically, they were trying to make sure the economy didn't fall or collapse to a greater deal than it did during the financial crisis. And so they did a lot of things that I'll address here in a few minutes. But basically, they wanted to prop up the economies, and that didn't just happen here in the US, it happened across the world where governments were stepping in and intervening to try to make sure things didn't get any worse than they were. So as of when I created this slide deck, it was the 19th of February. A lot has already happened in less than the first 2 months of the year. So volatility, I named this the return of volatility. I think that's going to be the new normal, and kind of looking back historically at how the equity markets, the stock markets typically perform. It's historically been more volatile than what we've seen the last 2 years. So it's going to be getting back to the normalcy of volatility. So I don't know if that totally makes sense to a lot of people, especially anyone that's just now starting to really get into investing and follow those types of things. But over the last 2 years, it's just been too smooth of a ride. It was very unnormal of what markets should look like. There is risk involved with the stock market, so don't trick yourself into thinking otherwise. There's definitely volatility and risk associated, and what it comes down to is just making sure that you have a clear understanding of why these types of things occur and and have reasonable expectations. So we'll talk about that again here in a couple minutes, just because I think reasonable expectations is something that's going to be important moving forward. That 23%, 25% returns every single year, that's not a realistic expectation. So just because it happened this year doesn't mean that's going to continue. And it probably wouldn't be healthy if it did, because that would just create a lot more of downside possibilities moving forward. And so looking at the first few months of the year, that volatility ended up creating a correction. And a correction is a 10% adjustment from a recent high. And we got very near that earlier this month. And things have since stabilized a little bit more, still bouncing back and forth between negative numbers, positive numbers. Again, just supportive that volatility may be likely here to stay now for the foreseeable future. And one other thing that I'll just touch on briefly, I'm not going to dive too deep into it just because there's too much there to unpack, but cryptocurrency, if you haven't heard of it, you may have heard something called Bitcoin. Bitcoin is a form of cryptocurrency, and it came really widely reported on towards the tail end of 2017 and especially in 2018. So if you thought the markets, the US markets were volatile, the cryptocurrency markets were extremely volatile, fallen by as much as 50% in a very short period of time. Just my brief kind of overview of what to expect with that kind of developments in the cryptocurrency area is that those things are going to continue to be volatile. They are constantly creating different cryptocurrencies. So I think those are going to have a negative impact on some of the kind of more established cryptocurrencies. And really no one knows what to expect. Could be very lucrative. I would kind of consider it some form of a lottery ticket that you'd be purchasing if you were going to be investing in cryptocurrency. And just to be aware that also very volatile as well. There's a lot of risk involved. I would say a lot more so than the US-based markets. Some people would argue otherwise, but I think a lot of that has to do with hysteria and kind of just trying to jump on something that's the new hot thing. My generation kind of grew up with Beanie Babies, and Beanie Babies had their own hysteria where rare Beanie Babies were being sold for multiples that not a normal sane person would pay, but there were people paying that much for it, and that doesn't really exist now as far as Beanie Baby hysteria. So that same thing that was purchased for an extremely high multiple would be not anywhere near worth that value now. So it's just important to know that some things that can burn really bright and then they can burn out as well. That's not my particular assumption on cryptocurrencies, but I think there's too many of them. So a lot of them are going to burn out, and there may be some winners there. But if you're investing money, just know that it could be worth significantly less than what you invest in. So keep that all in mind. 2018 and where we are headed. So it looks like low unemployment is going to continue. And one of the things that caused that volatility earlier this year was the impacts of potential higher inflation. So that Fed started to increase rates over the last year, and things have steadily progressed to where higher rates are becoming closer to being normal. They've historically not been normal when we look at things since the financial crisis in 2008, where the Fed artificially held rates to practically 0%. That's why mortgages were so low of interest rates, and that's why same things with vehicle loans and things of that nature. So those things are starting to creep up, so you'll see mortgage rates start to increase. But those things all kind of play together and may increase the cost of what goods could be. It may mean that your wage may go up to kind of keep up with inflation, and because there's more demand now for employment as that unemployment pool starts to shrink. So all those things kind of play together in ebb and flow. Just so you know, the Federal Reserve is targeting about a 2% inflation. So inflation is actually normal, and it's actually good to have. But what you don't want, typically, most people would say that you don't want uncontrollable inflation. So if inflation tomorrow was 20%, then the next day it was 2%, and the day after that it was negative, you're kind of talking about deflation at that point, where you can buy like twice as much of something because of the volatile nature of what inflation means on your purchasing power. That would not be good for any type of economy. And so that's why there's certain things in place, monetary policies in place to kind of control that. And so 2% is that normal amount that they want to strive for. If it jumps up too quickly or falls down, then that may be cause for concern for those that are looking for things to be more normal moving forward. So the Fed is starting to gradually increase rates. They've done it a few times last year, and they'll continue doing it in 2018 because everything looks so well. They also are looking to reduce how much money is in the economy because they poured a whole bunch of money into it early after the financial crisis to kind of stabilize and support the economy, but they're going to start reducing their balance sheets and reducing the money that's in circulation, which again would impact inflation as well. So what does this mean to you? Someone that probably has some type of investments in equities and bonds. And with that, I would say that the equity market, it's pretty common knowledge that the market valuations are high. So the fact that the markets have run up as high as they did last year means that there's more risk now than there was before 2017 started, basically. Again, saying it probably for the third or fourth time, volatility is going to be back. And so that's important to remember. I also already said that those high 20% returns is not likely to continue moving forward. And so it's not likely you'll continue to see double-digit growth, or at least not to continue too much past 2018. So I'm sure that there could be some surprises and the economy could still continue growing quicker than what people anticipate at this point, which would be reason for double-digit growth. But I would say not to expect that. Most estimates are going to be the mid single digits. And so at least for the US based economies, there's actually, from a risk versus reward standpoint, most people are saying that international economies may outperform the US again. And so I mentioned it, and I think it's important, is having a balanced approach, that you have some international exposure as well as US based investments, because you never know when those are going to occur. Just because experts kind of research these things, most of the time they're off, and sometimes they're off by a couple of years. So if you're making a guess and you're off by a couple of years and you are betting heavily one way or another, then there's a high probability that you may be wrong there. Market valuations tend to be pretty fair. There are concerns about interest rates rising and pressure from that. But like I said, 2017, interest rates are rising and bonds held up pretty decently for 2017 despite that. What you can do moving forward is have a diversified portfolio. Don't make drastic bets. Hopefully you're starting to plan earlier on than what most people are doing, and so you have time on your side to where you don't have to make risky bets or try to win a lottery, hit home runs, things like that in order for your plan to work out. So as long as you start early enough, you are going to have a lot of flexibility, and you can have a lot of safety in having that diversified portfolio. If you know that you're not really going to be on track with kind of more normalized returns, then the real possibility is that it's probably going to be better and safer to think about working longer, spending less money now, which means you could be saving more money now, or spending less money in retirement, things of that nature. Those are all different things that you can control. And so again, what you can do, don't bet on things or try to make huge aggressive moves on things that you don't know are going to play out, or that you can't control. So these things that you can do are definitely within your control, and that's where I tend to focus on pouring your thoughts and strategy behind. So with that, I want to thank you for watching this presentation, and feel free to reach out to me if you have questions, whether you're my client or not. I enjoy helping people, and I just want to make sure that everyone is confident with what actions they're taking now and what their future looks like, because I believe that possibilities are endless if you start building plans and start having different ideas of what's going to motivate you to make those radical changes that you may need to make in order to achieve your goals. So thanks again. This is Lucas Caceres with Level Up Financial Planning, and feel free to reach out to me if you have any questions.